Hey guys, good morning. Um, so, crypto is correcting. Let us hope and pray it continues because, of course, that's not a certainty. But maybe just share some things here first that are very important as an investor. Shared on Twitter yesterday, but it's very true. Wait, there was a quote here from Larry McCarthy. Higher prices bring out buyers, lower prices bring out sellers. Size opens eyes. Time kills trades. When they are crying, you should be buying. When they are yelling, you should be selling. It takes years for people to learn those basics if they ever learn them at all. And for me, it took 2 decades to learn that. I still made the mistake in 2017 to not sell at the top of crypto. Even though I called the top and I sold a piece, I went from 90 to 70% exposure. It was a capital mistake to not sell more. Of course, at least to minority exposure, actually, should have sold them all and gone short. But 2017, I started investing. Actually, my first investment was in 1999 in the dot-com bubble. I lost all my savings in 1 year. That was my first lesson. But 2017 is 20 years later, and I still make such mistakes. I hope I'm done with it, and I'll be buying when it's low and selling when it's high. But it's the most difficult thing to learn because the masses, the fear and greed are such strong emotions. They all you need lots of willpower and wisdom and plan, just a very strict plan to stick to it. A little bit the same as dieting, keeping the weight off. Is simple: buy low, sell high. But keeping the weight off is simple. Just don't eat too much. But it's much easier said than done. Um, um, so that's why I share what I do, so that you can see my blunders, but also that I share just I just put in the work to make such a plan and to stick to it. And this is one of the important elements here is the logarithmic regression of the crypto market cap. Logarithmic regression, I don't call it. It's also called the trend line. Is the red line here, and of average prices. And when you're investing, you want to see, is it relatively undervalued or overvalued? That's the most important question. Is the asset seriously undervalued or is it seriously overvalued? But to be objective in that is very difficult because when it goes up a lot, you have the tendency to also want to buy in because you want to have those gains too, but you're already seriously overvalued. Big mistake. Inversely, when it goes down a lot, you want to sell because it's so much pain, it's so depressed. For example, in Bitcoin Cash today, you see that, or in oil tankers. It's very difficult to invest in something that's depressed. You just want to get rid of it, even though when you see the great fundamentals. I don't have the Bitcoin Cash. I do it with oil tankers. Yeah, it's not easy. Because there are so many other things that go up, you're missing opportunity. So this is what we do with crypto here, and the question is, and of course, okay, we just corrected a bit the past week. We went from a high of 390 billion to 320 billion. Where are we? Are we seriously overvalued, undervalued? Well, we're fairly valued. Okay, we went down a bit, but we're much closer to the red line than to the bottom here. Okay, we're also not overvalued. If you know crypto exposure, of course, you're still in undervaluation. We're about 20% undervalued versus the trend line. And the trend line, by the way, is pulling down. Every time I update this, even if it's 2-3 weeks, the trend line gets pulled down a little bit because of the prices being below the trend line. And so the trend line, like say 2-3 years here, is now 410 billion. But it was also 410 billion 2 weeks ago when I shared my last video. When was that? Somewhere here or so. Here it was 410. Then I add these new prices. This is still it's 420 billion. Then I update the trend line. I make the calculation and redo the calculation based on all past price history, also the new price history. What is the average trend? What is the trend line? What are the average prices? Always get pulled down a bit now. Huh? So instead of 420 billion, it's actually 415 billion. So we're now at about 20% undervaluation. That's not my target. Huh? So my crypto investment plan is based on okay, what's likely going to happen. Huh? My thesis is that it's likely that we'll be at 60% undervaluation, hitting that several times over the next year. Huh? Just like in previous bear and early bull markets of 2011 and of 2016, 17, sorry, not 17, that was a bull market, but 2015 and 16, bear market, early bull market, we have always a higher undervaluation versus the trend line. Huh? We always go lower below the red line. So that's the most probable to happen. Not a certainty, no, but it's the most probable. So you want to bet the most money on that. And because that's been the pattern of the past and nothing has changed in the crypto market. Um, so we're not at 60% on valuation. That's my first buy signal. Okay, I can do it a little bit before, but 20% on valuation is not even close to that target. Huh? The target is 60% on valuation today would be not actually it's 320 billion today, not 360, but it would be 160 billion and not 320, 160. That's a lot lower than here. Huh? And most people won't will be people that invest in crypto will not invest here because they will long by that time have shot all their powder already, huh? Because people don't expect that to happen, huh? They think it's not likely, but it is likely that that's going to happen, huh? That we're going to 60% evaluation several times versus the red trend line that goes down over time actually, huh? No, it goes up over time, but every new prices it sets a little bit lower. So that's very important. Also, a great quote. I was studying Larry McCarthy. I didn't know him. A Wall Street legend, died in 2013. Some other quotes for him I think are great. Uh, Never blow your powder early. Start slow and low. Get feel of market is get a feel of market. Make sure you got tons of ammunition. Don't quit early. When it's going against you, keep going because it's gonna turn, and in split seconds when it turns, hit it real hard. That's how you win. And he's very right about that. Huh? Never blow your powder early. I've done that way too much, like with oil tankers, immediately taking my 30% position immediately in. I did that with crypto again after the bear market in 2018. Crypto went down a lot, and I said, okay, now my price target is hit. Everything, let's invest everything. Of course, it goes down even more. Also, a quote by Larry McCarthy is that, well, I don't have the quote here, but when you think the bottom has hit, it will go lower. When you think the top was hit, it will go higher. So that's why you never shoot all your powder immediately. You do it in steps. I did with Tesla also again. I sold it all my options, 30% exposure immediately in one go. And then I held my shares, and I was around $1,000 Tesla. I held my shares. There was another 30% allocation, and I sold it all at 1,500. Mistakes. Should have sold it in steps because Tesla ended up going not to 1,500 but to 2,500. So a lot higher. Um, but okay, that's life. But you learn. I always learn a little, and that's how you become a great investor. Always learn a little from you, learn something from your mistakes. um, so that's for crypto. um, Then my portfolio, I found a great solution. I shared in my last video my portfolio strategy, and my portfolio composition. And I had stocks here, but I think I can remove it. The problem is, I don't like a cluttered portfolio. It's a very bad idea. You need to focus. Huh? Um, Yes, the golden grail in investing is to have have different non-correlated investments, so that there's always one working out. And if you're wrong about one, there's another investment that can save your portfolio. That's the golden grail. But at the same time, diversification is. I mean, you very quickly diversify too quickly that it's at expense of your returns. So it's very difficult to balance that correctly. Huh? But if your portfolio looks cluttered, you're certainly not doing it right, huh? Because it's just too much. So I think what I shared before, I had also a stocks a goal here. I removed that, and I think I can remove that. I said I can't remove it because I don't want with my shorts that I plan to take on gold and on losers. Um, uh, I cannot invest that money that I get from these shorts also into crypto and oil tankers, because it's I want to have another non-correlated asset. Huh? But the problem with that was that if I add stocks also, yet another, let me just show that. So this is what I showed last time. Huh? Here you see also stocks now. Huh? But the problem with this portfolio is it's too much. It's too much. One, two, three, four, five main positions. Is too much. Huh? And also the problem with that is that you start to invest in things that you don't really know much about. Like I started investing in Lemonade. I didn't study that company. It's just basically a stock pick from someone, Chicken Genius Singapore, a YouTuber that I admire and that I believe does good, probably is good at stock picking. But that's not wise to invest like that. You should really be convinced of something when you invest in it, because there will always be hard times when you invest in something. If you're not convinced, you have weak hands, you will sell at the wrong time. Um, mm, um, eh, and then I also added ARK Invest, their fund, their main fund is of course a great fund, but they've done extremely well already. Huh? And I mean, investing in fund managers that have done very well is statistically not the good idea. You better invest in fund managers that did terribly, because they have a higher chance to do very well actually than the ones that did very well. Because yeah, that's how it is. You would think that track record for fund managers is very important, and it is very important. But if they just had a winning streak, then you also don't want to invest, huh? Which is the case with this with Catherine Wood and her ARK Invest fund. So not bad idea. That's a problem. You become you diversify too much. You add crap to your portfolio, and it will cost you in returns because you have just the overall risk reward of your portfolio goes down, which I haven't plotted here, but should be done too. Like with if you add investments that have a lower risk reward ratio, well, your portfolio goes down in risk reward ratio. And so your expected outcome, your edge, goes down too. And so your expected return goes down too. So I really wanted to try to get rid of that. And I think I found a solution by, and I might make a logical mistake here, but I think it's correct. The cash that I get from shorting, I can, like, because I was thinking, okay, Kelly recommends 60%, I can only go to 60%, but that's not correct. Yes, but Kelly means 60% of your available funds of the capital, the total capital you invest. 60% of that. And if you're shorting, then you have a bigger portfolio because you have extra cash. Like if I indeed succeed in shorting these, that's about 40% total. That means my total portfolio is not 100%, it's 140%. That's the cash that I have available to invest. And that cash, that 140%, 60% of that I can invest in crypto. I think that's the correct logic here. And therefore, if Kelly recommends 60%, I can actually go 60% of 100% plus 60% of the shorts of 40%. And that's then about 80% actually of my portfolio that I can invest in crypto if these targets are hit. Same for the oil tankers. And that solves my problem. Now I don't need to invest in stocks. The only argument against is, of course, it's not, yeah, you have less uncorrelated investments. That's true. Like that's what I liked about stocks, especially these kind of stocks. They are growth stocks. They are not value stocks. Oil tankers are value stocks. And so it's interesting to have a different sector as stocks because one can perform while the other does nothing. But cleaning up your portfolio and not having too many investments is more important actually than this argument. um, um, because it's also a question of time. Like, yeah, if I would be able to find stocks that have serious strong conviction like I had with Tesla a year ago, okay, that's another story. But I don't have that. I don't have that. I haven't done the work. I don't see the opportunity. So I'm not going to do that. So I'm going to get rid of it. Um, uh, because my selections are pretty poor. And I can better continue to just focus on crypto and oil tankers, especially if these targets are hit. These are tremendous attractive. If that would happen, tremendous attractive investment opportunities. And for me, it feels like, okay, if I take this extra risk of shorting, I also want to like really make it worthwhile. And if I invested in stocks like Lemonade or some ETF fund on the stock exchange, it's much less opportunistic than investing it in Ethereum or Bitcoin Cash at those prices. That's a steal. Or oil tankers that have very, very limited downwards potential if they correct again due to general stock market correction. And also, like, for it's good to be long short gold, long stocks, but actually I already have stocks. It's oil tankers, and oil tankers are not um, um, gold mines. They're not correlated to the gold price. No, they are totally correlated to demand supply, a balance of amount of ships available versus the demand for oil transportation. It's a very different business, not correlated. But it is correlated to oil price. If oil price goes up, usually oil tankers also are able to ask higher fees. And the play here is that if we get a commodity boom, and I'm wrong about this because I don't think we will get a commodity boom, not at all. But if we do, then my short gold will be terrible. Gold will double. I will lose lots of money there. But in that case, energy commodities like oil, coal, gas will go up a lot also. And so oil tankers will also go up a lot. Their last boom was from 2000 to 2008, the commodity boom. During the commodity boom, oil tankers also were an amazing investment. So if I'm wrong about shorting gold, this is a great hedge already, oil tankers. I don't need to add another hedge of growth stocks to protect myself against that. So I'm very happy that I saw this before I bought it. Mostly I did bought a little bit, but 2%, but not the 30% I was planning or so. So I can just hide this, put it at 0. I'm just gonna sell that off probably. And I can remove that. I think that's amazing. Hide. Very nice. So much cleaner portfolio that will likely lead to higher returns. Um, So that's the portfolio. And then people were asking me about the previous video. Can you explain the Kelly calculation? And someone also noted that it's interesting that Kelly doesn't value very much the upwards potential in its allocation calculation. For example, the upwards potential here is a lot higher for crypto than for oil tankers, yet the recommended Kelly allocation is about the same. And that's because well, let me explain how the formula works. It's simple. It's You need to plot out these. What's the upwards potential? What's the probability of that? What's the downwards potential? And what's the probability of that? Um, I do the probability of downwards potential. I fill in, and from that automatically you get deducted the probability that it's not going to happen and it's going to go up. So if this is 20%, this will be automatically 80%. So from this you get a simple calculation. Your expected outcome, you do this times this plus this times this. That's the expected outcome. U3 times T3 plus W3 times V3 is the formula here. And then you have the expected outcome. That's what you can expect to make. If luck does not play its part, then these are the returns that you will make. But of course, that's not how the world works. It will fall in one camp, so you don't get the expected outcome. But that's what, if you play this many times over, the kind of return that you would get. But that's not how it works. You only play it one time, and so it's a little bit a roll of a dice. But how does Kelly allocation then is calculated from this? It's very simple. It's the edge over the upwards potential. That's the formula. So it takes x3 here, x3 over t3 over t3. So it's 1200% over 1500%. That is the Kelly allocation. It's a simple formula. It's genius. It was discovered actually by Mr. Kelly, and he actually discovered that for a very different application. It was to distribute optimally the electricity through wires or something very scientific. But then it was Edward Thorpe who saw that this could also be used for the capital markets to make optimal allocation decisions, to have optimal profits. And it could also be used in the gambling markets. Edward Thorpe was a great gambler, and Larry McCarthy also. I shared an article on him, very interesting. You can use mathematical formulas to have a much higher chance to win in gambling as well as in investing. Edward Thorpe used it wrote a book, How to Beat, what was it? The Dealer was his first book. The other one was How to Beat the Market, using the same Kelly formula. And Edward Thorpe is still alive. He's 80, 90 years old. And that's because he applies this to all fields of life, also to his health. He's very, very conscious about the risks he takes. For example, he doesn't fly with African Airlines, or he doesn't bike because, he's very careful not to fall at all age, because then you break your bones at old age. It's a very high cost to pay. Or actually sanitizes his hands already a long time, much longer than we do here with the corona. He's been doing that since the middle of his life, to make sure that he doesn't get infections and all that. So he's very, very thoughtful, Edward Thorpe. But he discovered these things and applied this formula for the first time to the markets, and made a killing with it. He became a billionaire thanks to that also. So he actually really does not like risk, and he avoids risk, and that's why I have such high returns. He wants a certain bet, and it's an amazing invention of him, and it's so underappreciated in the investment markets because it's like super important. Huh? To allocate correctly, because if you allocate too much, you can prove scientifically that you're going to go bust. Huh? You see that very often in the markets. Tesla today also, people, they are always over allocated in beginning, not when prices are low, no, then they are fearful, and they don't, yeah, allocate too little. But then when prices go up and you get a bubble, then they stay invested. They are way over invested. They have a major allocation to an asset that's likely peaking out. Huh? Um, so 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 Kelly allocation can really help a lot in avoiding that, because you make a rational calculation how much you should be allocated based on your expected upwards potential, and risks and probabilities. So that's the formula, and I also don't have the answer. Why does the formula value the chances higher than the upwards potential? Huh? Because these are almost the same. Uh, like crypto has a much higher upwards potential than oil tankers, but the probability that oil tankers go down is less if we reach those targets than, for example, crypto. And why? Because oil tankers have income, they make money. Like, it's already selling for a PE ratio of 3 or something, or 4. So if it cuts by another 30%, what's the sorry, if first it's cut by 30%, then I would buy, huh? Because those would then uh, be the odds, and the odds being that, okay, it's lost 30%, what's the chance that it loses another 30%? It's a very low chance, actually. I didn't even do that. It's not 25%. Maybe it's 20%. Huh? Oh, mic is up, one moment. Mikey is up, huh? Mikey likes cars very much. Huh? Mikey, you like cars? Huh? Like this one, for example. Huh? A beautiful McLaren, huh? McLaren. Amazing, huh? There you go. There you go. This is actually a epic car. But um, if I change that, yeah, because the probability for oil tanks to go down once it corrects is less than for crypto. For crypto, I have 20%. Then it corrects another 20%. I have that from here. I know that's a big leap. Bless you, bless you, Mikey. Bless you. Huh? Mikey is now over already 1 year old. Huh? Yeah, it's a smart boy. So 100, if we reach 160 billion, to go down another 20% and go to 140 billion, I think the probability is very low, because that would mean that we double test the bottom. And double testing the bottom, I don't think is likely, for reasons given in other videos, because we already did it. Sorry, actually, I should call that triple testing the bottom. No, sorry, double test. We already tested the bottom. We're not going to test the bottom twice. That's unlikely. Testing the bottom do only one time usually, and that happened in March when we went to under 20 billion. Very shortly, we already did that. Huh? So we're not going to do that again, likely. Huh? What is er, jongen? Huh? What is er, jongen? Huh? What is the problem? Huh? What is the problem? You want to drink something? Huh? Yeah, we have found some great toys here. Eh? Oh, look at this! Look at this! Eh? Look at this! Huh? You gonna take the car, Mikey? Huh? Take the car there? Huh? There? Yeah, you're not gonna take the car. So that's why I have these odds here. Yeah, look. Mike is gonna do it. Mike is gonna do it. Are you ready? Almost. Let me do it, Mikey. Let me do it. Hey, wow! Look at this thing. Wow! 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 Look, I bought this toy. I think it's amazing. I mean, if you're a child today, your toys are better than the ones we had when we were children. Look, this is such a powerful car. You can make the racetracks everywhere. Oh, he crashed? He crashed. It does need some work to get it all working. But yeah, I don't have the answer why the Kelly formula values the probability to lose money higher than the upwards potential, but it does. Huh? And as you can see, it's now the same. It recommends the same allocation, but that's because even though the downward potential is a little bit higher, but I also don't think that's accurate here. Downward potential 20% to lose another 30%, 20% to lose another 20%. But that's my judgment. But this is a rough estimate. I really didn't do. If you already drop 30%, to go to 150, for example, from here is also a drop of about 30% or 40%. So if crypto drops 30% and oil tankers drop 30%, I believe that the downward potential for crypto is only 20% to go another 20% down, and only 20% to go another 30% down. Yeah, that's the rough estimates for oil tankers. Basically recommends the same allocation. But do you do full Kelly of half Kelly or half Kelly is of course also an important parameter. And here I say actually I should for oil tankers take only half Kelly. But the problem, what's the case with oil tankers is that, and here we have a Porsche. The problem is that, but oil tankers, I believe, actually do have a less downward potential. But yeah, okay, it's not my favorite investment, so I should actually invest less in it. And here is where you can be more subjective. Huh? But a half Kelly is generally recommended because well, of reasons that you can read here if you go to the chart. I know I didn't share it here. Half for full Kelly, but I did share it here. Half for full Kelly is the same text. This sheet I shared, you can read it here why half Kelly is strongly recommended. And you should only go higher if you have if you feel that you have a much higher chance to be right than usual. Because investment markets are very uncertain. But I think, yeah, you can apply that to all tankers because they have revenues. And revenues sets a bottom at how deep the valuation of a stock can go. Unlike crypto that does not have revenues, but crypto has users, and that also sets a bottom. Real adoption also sets a bottom in how low it can go. But of course, real adoption in crypto is not impressive. So I should probably play a little bit with those numbers. But I change this from 60 to 50.